Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining us. I'm your host, Lance Pederson. This is the Real Estate Risk Report. So today I have with me Brian Briscoe. He's with Four Oaks Capital. How you doing today, Brian?
Doing great, Lance. How you doing?
Doing good, man. Well, I'm just noticing now too that you are a Washington football team fan. So congratulations on making the playoff.
Yeah. You know, actually, funny thing about this shirt, my wife got a gift certificate to like the NFL shop, and I've never really attached myself to any team, yeah. So we were looking at all the shirts that were available, and looked at the Washington one, and the reason we got it is because it just says Washington football team. It was obviously the Redskins previously, and they'll probably have a new name now, but just for the novelty of the shirt, the 1 or 2 years they'll have the no name team. But
there you go.
Anyway, yeah, funny. Yeah, I've never really attached myself to the Washington football team.
Well, they've got Alex Smith at quarterback. He's kind of the comeback story of the year. So it's always good to root for a guy who's, and I heard he was trained by some ex-military guys to kind of get him back into shape. So,
so Alex Smith, I'm a Utah grad, and Alex Smith played at Utah college ball. So that is one thing about the Washington football team that I can, I can join with him on. So, I followed Alex Smith since, his days at San Francisco to Kansas City to Washington. And I remember when Washington picked him up recently, it was just one of those, well, there's at least one reason to root for the hometown team here. So, we're in DC now, but it's more, we've always looked at it more as a temporary thing and not really, that's the thing about military is usually when you go someplace, you're not going to be there long enough to grow roots. So, in a way, you never try to get too attached to things. So that's kind of the downside.
Yeah, very good. Well, it's a good segue into, why don't you share a little bit with us about sort of your background, and how you ended up getting into real estate, and how Four Oaks Capital came together. And I'm assuming there's some meaning to the name. I have a hunch of what it probably is, but be interested to hear kind of what that's all about.
Yeah. So, Four Oaks Capital is, the name's simple. There's four of us, so there comes the four. And we operate in the Southeast, and the Southeast, the oak tree is kind of a symbol of security and longevity, so that's really the meaning behind it. We wanted something that evoked the idea of, we're going to be around for a long time, and we're going to be solid company that just, continues to produce and produce and produce. But yeah, as far as my history, I'll take you back very briefly to, 2001. I wanted to be a college professor. I was actually in a PhD program at the University of Minnesota. And the World Trade Center went down, right? So I think that's probably an event that most people remember. But for me, it was just a very critical juncture in my life. I looked at continuing in the PhD program, which I really wanted to do. And then, I was 24, 25 years old. I'm thinking, you know what? I need to do something, So long story short, ended up talking with, Marine recruiters, and ended up, very shortly on active duty. So I had originally intended on doing, 3.5 years. That was the shortest contract they would let me sign, is 3.5 years. And I purposely, went for the shortest contract available so I could get back to school as soon as possible. But it's been 19.5 years since, and I'm still in the Marine Corps. So anyway, along the way, I would say, probably 2005 timeframe, I was stationed in Okinawa, Japan. And I read Rich Dad, Poor Dad. And that was really kind of like the catalyst that got me into real estate. And, there was a lot of limiting beliefs on the way. It was, the whole concept was brand new to me. I equated Poor Dad with my own father in a lot of ways. Didn't grow up in a house with a lot of money, working class father. But read that book, and I remember thinking, I can't do all that crazy stuff he's doing, but I think I could probably figure out how to buy a single family house.
Mm-hmm.
and that's what I did. So we picked up a single family house in my hometown, Salt Lake City. And, a couple of years later, we picked up another one in San Diego right after the market crash. And my idea was, I can do Rich Dad, Poor Dad, but, only a little bit of it, because I just don't have what it takes, I guess. But end of the day, I made this idea. I made this plan. Every time I move with the military, I'd just buy another house. And slowly we ended up with a handful. Not very many, but we ended up with a handful of rental homes, and kind of had proof of concept on that one. And at one point, I started realizing, it wouldn't be too difficult to do more. It wouldn't be too difficult to go from this, family to maybe doing a duplex or a fourplex or something like that. And so I started looking into it. I started looking into what it would take to get a duplex and a fourplex. And, eventually I started realizing that, why stop at 2 or 4? Maybe I could do a little bit more. And that's really what got me into multifamily, was just the idea of scaling, being able to very quickly get more and more assets under our belts. So at the time, it was there was no us at the time, but I really appreciated the fact that multifamily is almost like a buy one get X amount free. To get 30 single family homes, I realized would take 30 down payments, 30 closings, 30 sets of closing costs, and then I'd have 30 roofs to maintain, and 30 driveways and whatnot. But anyway, I realized really quickly the economy of scale was there, and started pouring a lot of time and money into educating myself. So that was probably 2016, 2017 when I really started turning the corner on multifamily. And, come 2018, moved out here to DC, and that's really where I kicked it into high gear. I think part of me realized, when I moved here in 2018, I had 17 years of service. And if you're familiar with the military at all, at 20 years, you can retire and get a pension. So I realized that 3 years in the DC area could take me to my retirement. And I really started to looking at multifamily now instead of a hobby, like I kind of looked at my single family homes, but more as a future career and a future business. And I started treating it like a career and a business. And, since then, I'll gloss over, 3 years of hard work and just say, since then, we've been able to close on almost 500 units. That's Four Oaks came together, a lot of hard knocks and a lot of lessons learned. But anyway, that's kind of general overview, and we can dive in anywhere you want.
Yeah, no, that's a great story. Yeah. So I think you said before we jumped on, so your retirement is coming up here this year, right?
This year. Yeah. So should be probably end of July.
Yeah. That's great. Well, congratulations and thank you for your service to this country. It's appreciated.
Thank you.
So for you guys then, you got the band together and became Four Oaks Capital. I mean, how did you guys decide, where you wanted to transact? Was that like a process of deciding, hey, where are we going to invest? Or it was sort of you stumbled into those deals, or how did that kind of play out?
So, yeah, I mean, funny you ask it that way, because we actually came together when we realized that we were competing on stuff. So, rewind, I'm in DC, and DC is probably one of the worst places to invest in multifamily. It's just that the cap rates are extremely low. The barrier to entry is ridiculously high. So that there's lots of barriers getting into the market here. A lot of the big players are in DC area too. So a lot of competition. So when I moved here, I started looking at markets, and, I basically looked all up and down the East Coast and decided to pick my favorite markets based on a handful of metrics. And the Southeast, I looked Northeast, I looked, Mid-Atlantic, looked Southeast, and, that the Southeast is that the numbers really were popping there. So started looking in the Carolinas specifically. And added bonus, my wife is from South Carolina, and we had been stationed together in North Carolina for a couple of years. So we knew the Carolinas better, And the numbers just made sense. There's a lot of growth economically and population wise. But the way Four Oaks came together is Eric and I, Eric's our director of acquisitions. Eric Shirley and I realized at one point that we were talking to the same brokers. We were analyzing the same apartment complexes, and that we had competed against each other on a couple of properties prior to that when we met. And when we realized that we were competing and maybe unintentionally kind of driving up prices on each other, we decided to try to collaborate. And at first, it was a very narrow collaboration. It's like we would collaborate on deals if they meet, these three criteria or whatever, So, and part of it was regional. We were both looking in the Carolinas. Eric was looking in a couple other areas. I was still looking in like Salt Lake City, my hometown. But long story short, we realized we were competing, and Eric just said, "Hey, let's try to collaborate on a couple of things and see how that goes." So we collaborated, and that's what brought the team together. But as far as markets, since then, the Southeast is still where we like to stay for a couple of reasons. Number one, we have a physical presence there. Two of my partners currently live in the Carolinas. One of my partners is moving in the next couple of months from New Jersey to North Carolina. And, my wife still has a ton of family there. So we're in the Carolinas a couple times a year. Pre-COVID, we were in Carolinas, 2 or 3 times a year, even before we started looking there to invest.
Mm-hmm. And so, like in particular, is there a market in the Carolinas that you really, really like, that you're bullish on sort of, moving forward?
I would say my favorite area is upstate South Carolina. And it's an area that there's not a lot of focus on it, but there's a lot of goodness happening. So if you don't know where that is, most people know where Charlotte is. Most people know where Atlanta is. Mm-hmm. I-85 connects the two cities. Mm-hmm. Basically, I-85 corridor through South Carolina is upstate. So it has Spartanburg, it has Greenville, it has Anderson. Clemson University is there. A lot of good stuff happening. Recently, Spartanburg was, I think the census put out a report saying it was like the 19th fastest growing city in the nation. And in Greenville, there's a lot of growth there. So we like it for several reasons. Also, it's not a major metro, and carries a little bit more risk not being a major metro, but the combined population of upstate is over 1 million people. Mm-hmm. So it's big enough where I think you mitigate a lot of risks that you have in smaller markets. But it's small enough where you're not getting all the competition that you get in your Charlottes or Atlantas or Dallases.
Yeah, no, makes a lot of sense. Yeah. So for you guys then, what kind of stuff were you looking like? You minimum 50 units, 100 units, like class B, deep value add, light value add? I mean, what's sort of your buy box? So
when we started, and it's our first deal was B class value add. Everything else we've done is C class. And the first one we put together was 2 apartments from the same owner. It was a 16 unit and a 39 unit. So a total of 55 units together, B class value add. And we had in mind when we started getting into the 100 plus units. So it just took us a while to get there. I think it's some people can start, with a 100 plus unit. We looked at what we were able to do and decided to kind of slowly ramp up to the 100 plus. But right now, our buying criteria, we're looking for C class. We like the 70s and 80s vintage. We're looking for something that has a value add component. So maybe it hasn't been, renovated or updated in the last 15 or 20 years. In the end, we're looking for a problem to solve of some sort. Mm-hmm. So we're looking for something that's lagging behind the rest of the market because there's something wrong with it. And we can come in and figure out what's wrong, fix it, and reposition it. And that's exactly what we're looking for. So C class, value add, we're looking at something workforce, definitely workforce housing, which is true of most C class, and Carolinas and Georgia is what we're looking at.
Yeah. So do you guys have like who like property management? Do you have do your own property management, or do you hire third party property managers?
We have two different property managers. I mean, right now we have 485 units across 6 different apartment complexes. We actually have 2 different management companies that manage the portfolio. One company, it's a smaller company that manages the 2 we have in Spartanburg, and the guy who manages has done a phenomenal job. Just so happens his office is right across the street, which is super nice. It's like having on-site management at off-site prices. So
yeah,
we're happy with that situation. And then we have another property manager that's a little larger. They manage, I think, 6,000 to somewhere between 6,000 and 8,000 units total. And they manage the rest of our portfolio.
Yeah. So kind of post acquisition then for you guys, I mean, what are the things that you're, kind of looking to do, or the ways that you kind of, mitigate that risk? I mean, you're doing value add.
Yep.
So, repositioning these assets, and, there's some risk associated with that, but are there certain, kind of guiding philosophies or your playbook that you're running that to sort of ensure that you can execute your strategy? Or
there's a couple of things. Everybody says they underwrite conservatively, and I think one of the things that we're going to say the same thing. We underwrite conservatively, and I'll just kind of give you an example. We closed on an 82 unit in November, and our year 1 projected vacancy was 25%. I don't think anybody uses those numbers, but as far as the risk mitigation strategy, I think you hit the nail on the head. There is a fair amount of risk when you're going in and renovating. So are you going to the biggest question is, are you going to be able to make that, after repair value that you think you can make? Are you going to be able to hit those rent projections that that you're projecting? And the risk with the value add is, if you don't hit those numbers, the most likely scenario is you just don't hit the returns that you think you're going to get.
Yeah.
But I mean, worst case scenario is you actually lose money, so, we just closed on a $7 million deal, and, our all-in price with our capital expense budget and everything else is just north of $9 million. So we raised, $1 million and change for the renovations. But I mean, that said, the risk there is, if you put in $1 million of renovations and you don't add $1 million to the price, you're going to lose some money. But the way we mitigate it is we're just very conservative with our numbers. So when we look at projected rents over 3, 5, or 6 years, whatever the projected hold period is, we're not putting a lot of escalation in there. All right. We're not assuming rents are going to go up year over year. So we'll look at rents right now in the market, and that's our baseline for year 3 and year 4 is what the current market commands. So number one, we feel strongly. Well, we're optimists. I think there's been some issues with COVID in some parts of the nation. The Southeast has actually been pretty strong on rents and rent collection, but we feel that if the area that it's in can hit, say, $750 in rent right now, that's a very safe number to use 3 years from now. So that's one thing we do to make sure we can do it. And then the other thing is, we look at our exit price, and I think I would assume most people who listen to the show are familiar with the cap rate, NOI cap rate valuation method. The last property we purchased was in a market that averages a 5.6 cap rate, and we use a 7 cap as our estimate for sale. So if cap rates continue to compress, which, I mean, some people think cap rates are still going to go down. Some people are predicting they're going to hold firm. Others are saying they have nowhere else to go but up. But we have a lot of play in our numbers before we don't hit our projections. So the biggest thing we do to mitigate risk, I mean, the property manager helps a lot. The property manager has been in business for 20 or 30 years. They have extensive experience in managing renovations. And then with our conservative underwriting, we're able to to basically look at the risks, look at the worst case scenario, and we're okay with the worst case scenario. If we're not okay with the worst case scenario, we're not going to present it to our investors.
Yeah. So it sounds to me too, that just means that it's harder for you to train. If you have the discipline to be conservative with your projections, that means that most of the deals just don't pencil.
Yeah.
Right.
That's right.
And so and I think that, and everyone talks about it. It's just, the more and more I talk with guys like you, and it does come down. There's so much of it is discipline, right? Mm-hmm. It's about it, because it's, you make or lose the money on the buy, and everyone says that, but it's when you think about it, this is why, right? It's because it's the discipline to underwrite it conservatively, not just say it because that's what everyone's saying, but to literally say, I'm not going to be tempted to, plug in this variable that makes it look like this is the greatest deal, ever. Right. And stick with it and own it and say, it just doesn't pencil. It doesn't work. Because, many people, they feel that the fear of missing out and the competition of other people coming in and like, I don't want to, they fall in love with the property or whatever the case may be. And it's about the fundamentals and discipline, and I think that's where it goes back to, first things first, underwrite the sponsor, and the team. So like you guys I think you're a pretty good example. There's 4 of you, right? And you each have a role that's pretty distinct, correct? Yeah. So someone's in charge of acquisition, someone's in charge of asset management, someone's in charge of investor relations, someone's in charge of, education and oversight of the glue guy or whatever. What guy are you? You're like the glue guy, educator.
I'm the educator. I'm the big end of the funnel, and part of that's because I still have a full-time job that's fairly demanding, and I can do most of that, in my off hours. So, I'm not, unlike the acquisitions guy who's got to be, open during broker's hours, or the asset manager that's got to be open during asset manager, apartment PM hours. So that's my role. And you're exactly right. You hit the roles on the head. So we have one guy on each role, and the discipline, I think, is what really keeps us going, as far as making sure I's are dotted, T's are crossed before we move forward on everything. So and before any new acquisition, one of the things that we do as a company is all 4 of us have to say yes. Yeah. Before we get a new property under contract. So Eric is our director of acquisitions. He's got somebody working with him on the underwriting process. Kelsey's her name. She's awesome. But Eric and Kelsey are doing all the underwriting, and once they think they have a deal, they got to pitch it to us. And the other 3 have to be able to look over the deal and say, yes, this meets the criteria. And we do it that way for a couple of reasons. I'm not emotionally attached. I haven't, when I first see the deal, I haven't walked the property. I haven't talked to the broker about it. I don't have the bias. So when he sends me the numbers, I'm looking at the numbers, and I'm looking only at the numbers. And then, give him a thumbs up or a thumbs down. But end of the day, it's, you got to have the systems that keep you disciplined and keep you tied to your criteria.
Yeah, that makes a lot of sense. Yeah, and that's a good segue to the education stuff. So I know that you guys are, big on that. Obviously, you're big on that. Maybe share a little bit about, what your plans are with that in terms of. Obviously, this show, the intention is to help educate, right? Help and make investors better investors. Think like an active investor, even if you are a passive investor. But what are you guys thinking in terms of, how to help, kind of get more people up to speed? Because I think I was talking to another guy about this, but it's just, some of it is just, it's intimidating for a lot of people who do qualify. They are accredited, they'd love to participate, but it's pretty intimidating to get involved. And I think that obviously it's, the way to solve ignorance is to educate and inform. And so tell me a little bit about what your thoughts are in that front.
From the very beginning, there's a certain type of person that I naturally appeal to. And for some reason, it was always the the wannabe syndicator or the aspiring syndicator that would call me up and ask for time. So from the very beginning, I started, and I mentioned I wanted to be a college professor, so that stuff naturally appealed to me, and I'm happy to spend time on the phone with people, as long as I have the time to do it. That's the caveat. But what I started realizing is, most of these people were wanting to, they would talk about being a passive investor first and then getting into active investing. So, we had a lot of people who were interested in going that route. And so we decided early on, and we came up with this idea of education through investment. And so right now we're building out a platform so that anybody who's invested with us can get the knowledge and know-how to potentially syndicate later. And of course, we'll open it up to people who haven't invested with us as well. But it'll be free for life for anybody who's invested with us as a passive investor. But that's one thing that we're working on right now as far as the company and where the company's going. But the other thing is, when you're talking to passive investors, there's a lot of people in my network, and this is probably true of everything. I think 3 to 5 years ago, most people in the nation had never heard of a syndication. When you look at investment opportunities available to people, financial planners don't talk about investing in syndications because they're looking at market things that are traded on the stock exchange type stuff. So since it's considered an alternative investment, you kind of have to educate people about it before they're willing to put money with you. So I think the education process is vitally important. And I've also seen that if you take time to sit down and educate somebody who's a potential investor, they will usually end up investing with you. I mean, every once in a while, I'll get somebody that I've spent a couple hours with talking about X, Y, and Z, and they'll say, "Hey, I decided to invest with this company over here." But for the most part, what I found is if we spend the time educating people who are potential passive investors, when they are ready to invest, they're going to invest with us.
Yeah, there's no doubt about that. So what would you say the biggest sort of, since you sort of take that educational approach, what do you think the biggest misconception or, what is the thing that you're asked the most, the thing that they're the most confused about, or, is there some sort of recurring theme there that you feel like, man, this is the part that passive investors seem to struggle with the most?
I would say, in 2019, the biggest question I had was recession, because that's what was on everybody's mind. Mm-hmm. I mean, we had the inverted yield curve. I won't go into that, but there were so many economic pointers to an upcoming recession. And the main question at the time was, what happens if there's a recession? I would say during COVID, the big question on everybody's mind was, is real estate still a safe investment? What are your collections like? What's your vacancy, your occupancy numbers like? And I think recently, it's the questions that I get asked the most are trending with, what's on the forefront of, the media and everybody's minds. So yeah, recently it's been, are you going to be able to hit those numbers even with COVID? Are you going to be able to, what has your experience with COVID been? Have you been able to keep units full? Have you been able to collect? Those have been the big ones. And I would say aside from that, the other big questions that we get are mainly, structure, how we're going to give people money back, how people earn money off of it. Structure and timing are probably the other big questions we get.
Yeah. Do you see a lot of the people that you're meeting with that, that, like you said, they're sort of, and it seems like this is a progression. A very common sort of how I got into real estate. It's not too dissimilar from yours, right? Read Rich Dad, Poor Dad, bought a single family house, realized that wasn't very scalable, got into duplexes, fourplexes, 16 plexes, like multifamily.
Yeah.
Right. So, when you're talking with these people who are sort of like, well, I'm not ready to go and try to take down a 32 unit myself, but, invest with Four Oaks Capital guys. Mm-hmm. How many do you think will end up actually being operators? Or do you think that, I see this trend of the sort of, which I think makes sense, and I'm all for it. And I think that it makes sense that there's a group of people that are sort of rising up, which are kind of like mini private equity real estate shops of them to themselves. They got their own little tribe, right? And they basically are just, have their own base of investors and then are sort of choosing operators and, kind of raising capital into a separate vehicle. Is that the kind of stuff that you expect to sort of come out of that effort? Or do you think that you will actually spawn real life sort of multifamily operators that are going to syndicate their deals?
I think there's going to be a range. Just like anything else, I think there's going to be a couple people that, within 3 or 4 years are bigger than Four Oaks, and I could probably point to them, and say, those are them, but on the flip side, we'll probably have, a couple that are flashes in the pan that'll talk big, and we'll decide that it doesn't work for them, so, and I'm happy to see people succeed. I'm happy to help them out, because the better they do, it's one of those things where I think you've probably noticed in this industry, it's as many people who are in it, it's not competitive. It's not cutthroat. It's not like we're looking, across the aisle and saying, I've got to do something, I'm going to, slash their tires or something so they can't win the race. But how many, that's a good question. I would hope a lot. I've got my eye on a couple of them that are doing really well and, making really positive strides. And on the flip side, we're open to partnering with them as well, so where it makes sense. And when we can help out, we can potentially partner with people who maybe need, the experience to get the loan, or need the net worth to get the loan, or need help with the asset management once they get it. But so anyway, I think it's that there's a lot of synergy, that there's a lot of cooperation that can occur through what we're doing.
Yeah, that's good. And I do see that. And you're seeing, it's interesting because, 5 or 6 years ago, it did seem a bit to me as an observer, it felt a bit more like there was like it was people played like they were playing a zero sum game or something. And but I have noticed in the last couple of years that it is much more, cooperative, or, there's an abundance mentality. And I know for us at our firm, that's kind of how we've always approached it. It's just like, there's more than enough. This is the real estate, the middle market, the sub-institutional space is gigantic. It's just, there's no end to it. Trillions of dollars, where there's more than enough to go around, go around, and so that is good to see. And I like to hear that you guys are sort of embracing, because you've got these other guys, and maybe some of this is driven by that too. You can tell me if you want, but is just by some of these, there's just these gurus out there, right? Who don't do it. They just teach it. Right. And they charge a bunch of money, and it's, it seems, I don't pay too close attention to it, but it seems a bit shady in some cases. And I'm not sure if you guys saw some of that, or like, okay, so, that's enough.
Yeah, I've seen competition between, people who have, coaching programs. Mm-hmm. That's probably where I've seen the most competition. I won't mention any names, but, I was on the podcast. I went through coaching. Okay. I did coaching with, do you mind if I throw a name out?
No, I don't mind.
Okay. See, I did coaching with Michael Blanc, and I was on somebody else's podcast. And they asked me about my story, and I mentioned, I got into coaching with Michael Blanc, and, the demeanor just absolutely changed. It was like, no,
you're the enemy now.
We're going to cut that out, and it was just like, whoa, okay. And, we're going to edit this out. So just pretend I didn't ask you that question, and we're going to go back, and I'm going to ask you something else.
Yeah.
And I was like, okay, so, that kind of floored me. It was just like, wow, but, since then, I have seen, and publicly, most of these big gurus will, say they're friends and they cooperate and they act nice together. But I have seen a little bit of competition. I mean, that was probably the most drastic, stark moment. But I have also seen, a couple of these bigger operators that run conferences that are running conferences on the same weekend. And it's like, is that by chance, or is that kind of a, well, let's see if I can, rain on his parade a little bit. I don't know, but
yeah.
That's really the only place I've seen anything that resembles, a very competitive landscape. But, when you look at it, we own just over $20 million of real estate. And when you look at the entire market, there's room for a whole lot of us. There's room for, probably 100,000 operators like us. Let's see, 100,000 operators, 20 million. I don't know, more than that. Probably almost 1 million operators like us. So anyway, yeah, we're happy. The market's large enough that there's a lot of syndicators like us that can coexist.
Yeah.
And our philosophy is, if you're in our network and we find out that we are competing directly on a property, I would much rather collaborate and find a way to partner.
Yeah, no, makes sense. And it is refreshing. And I think that is the beauty, because a lot of this, as these assets change hands, and that's really, like you said, where it's kind of 70s, 80s, 90s product or whatever, a lot of that was more closely held, right? So, a lot of guys like you, I mean, you're buying it from people who've held it for a long time, and, they've it's run its course, and obviously deferred maintenance. I mean, that's the beauty of it, right? I mean, this is like cities. I mean, in Portland, I use that as an example. I mean, when I first moved here in, 1999, I mean, there were some neighborhoods that I'm just like, whoa, that's don't go there. And now, and 10 years later, it's like the hottest, coolest neighborhood you'd ever want to live. Right. That's the gentrification effect. But that's how real estate goes. It's just, it's cyclical, and it moves and it changes. It's just this living, breathing sort of thing. And, and there's more than enough room for people to, to change hands and that's what gets me excited. Right. And that's where I say, you need the operators, the guys, the boots in the ground, all those things. The thing I'm passionate about is sort of trying to provide some more standardized infrastructure right around these things, like reporting and all the nerdy stuff, the accounting stuff and the tax stuff. And, there's better ways to do it than what we're doing now. That's the good news. There's lots of opportunity there. But the more we can streamline those things, so that I just don't think those things should be differentiators. I think they should just be table stakes. The differentiator is the operator who can perform. It's performance. We bought it for this. We did this. We added value. We mitigated risk, and we executed. That's what it should be about. But being able to allow, and this is through education, right? Taking them from being ignorant to becoming enlightened. The more participants, the more capital that flows in, that's better. I mean, I'm not a guy who wakes up and is like, democratize, the whole thing. I don't need to go that far, but I certainly know that there's a lot more people who could be participating. And that's good, because that means that we're distributing wealth. Wealth is being built, amongst many, many people, rather than, just these super rich people who buy everything. I don't spend a bunch of time to think about that either, but that's what's happening. That's the movement. Like you said, 3 years ago, people didn't even know what a syndication was. Now it's sort of like everyone knows what a syndication is.
It's accessible. It's accessible. I mean, and most people have minimum investments, but you can find a syndicator who has a low enough minimum that almost anybody can get into syndications now. And that's the beauty of it is, just like you said, I grew up in a working class home. And it's something that is accessible to a working class family to be able to, save up 10 or 20 grand and be able to put some money in a syndication that can, start creating passive streams of income. And that's one thing that, I've really become passionate about. And I've started to kind of shake myself free of the conventional wisdom recently. And speaking of risk, I have, been on record as saying this. I think one of the most risky positions right now in this economy is to have a single income in a household. If you want to talk about mitigating risk, you've got to get away from being a single breadwinner in a household. And I don't think the answer to that is, okay, now let's, have both husband and wife go out to the market, or, whatever the arrangement is. That's not the answer either. I think, if you really want to mitigate financial risk, you need to be able to have multiple passive streams of income, or multiple streams of income coming in to be able to mitigate your risk. I think we've seen, especially in the last, 8 months, we've seen a lot of people lose their jobs, and people who've had single sources of income, ended up like, what am I going to do now? The government just told me I can't go to work. Yeah. What am I going to do? So I'm very excited about this industry. I'm excited that, we can help people get out of that very risky situation where all they're getting is a W-2 income, where they can diversify. They can start getting other streams of income and slowly build those up. Yeah,
I agree. Yeah. And also too, to steer clear from the crazy volatility and the nonsense of the public markets, as the only option. I mean, as they're seeing, right now, the bond markets are just completely upside down. Like there's no yield. Like, so it can't even solve problems that it's supposed to solve. Mm-hmm. Right now. That's what I mean. The issue does become is that for those that don't meet the requirements, for accreditation, accredited status, obviously there's some other, Fundrise, and there's some other ways to, Yield Street or things like that, some of their stuff, you can get into, but, so it's good. It's good to see that, because right now, obviously, multifamily with, it provides cash flow. It's a great, way to generate that as a income replacement. And, there's other products obviously out there too, but I'm with you, man. It's exciting, especially at a time when it feels like, I suppose every generation feels this way, right? That every problem's been solved. There's nothing left to do. But in this space, it really was kind of antiquated when you think about it, and really didn't make that much progress. So it's fun. It's fun to be involved in something where you can make a difference, right? Like you guys running your education platform, and that'll change people's lives. I mean, doing a podcast like this, or your podcast or whatever, and right now, especially people are really, really into investing, educational investing sort of content across the board, and, love or hate Robinhood or whatever. But people are starting to feel like they need to get up to speed finally, after all the, obviously you'll, think, after 20 years, you'll get a pension here. So good for you. But most people don't have a pension.
Yeah. And I've also been on record saying that the military or the government pension system is also antiquated and somewhat archaic. But part of me thinks it's absolutely sickening that, for doing zero work, if I live another 40 years, I'll get $2 million in today's currency, so for not working at all, and the taxpayer is paying that, so part of me thinks that is antiquated, archaic, and needs to be fixed. But I am still going to cash the checks.
Yeah, you will. So, yeah. You won't.
You won't send it back. I'm not going to send them back, so I don't feel that strongly about it. But yeah, it's one of those where you've got to figure out a way to build some income streams that aren't dependent on your time. And quite frankly, knowing that the military had a pension is the reason I'm still in right now. Right around my 10 to 12 year mark, we drew a line in the sand at the 12-year mark and just said, if we make it past our 12-year mark, we will go all the way to the 20 to get that pension. So that was one of the biggest reasons that I'm still in right now. After I made it to the 10-year mark, it was just like, well, I'm here 10 more years and I will have a pension for the rest of my life, as long as the U.S. government is solvent and paying its bills, So, anyway, that's definitely part of it. It was part of my decision-making process in staying in the Marine Corps. And I think it's on the mind of, anybody who's looking to make a career in the military is, I will earn enough money to keep the lights on. My pension, it's not going to be huge, but Idaho Falls, where I'm going to live, it's right around the median household income.
Yeah.
So, boom.
Yep. Yeah, it's good. Well, great. It's been awesome connecting and meeting you and spending some time with you, Brian. And appreciate you taking the time to be on the show.
Yeah, it's been a lot of fun. Thanks for inviting me, and it's been a great time for me too.
All right, man. All right. Take care.